everyone, and welcome to Beauty in the Biz, where we talk about the business and marketing side of plastic surgery. I'm your host, Maley, author of Your Aesthetic Practice, What Your Patients Are Saying, as well as consultant to plastic surgeons to get them more patients and more profits. Now, normally I interview surgeons, but today I have a special treat. We have a lawyer, and his name is David Mandell. He's JD and MBA. I have an MBA too, and you have, on top of that, you have some good degrees there. He's a partner at OJM Group in Fort Lauderdale, Florida. He's also authority in the fields of risk management, asset protection, as well as wealth planning. Now, David writes, speaks, and he's been interviewed by Bloomberg and Fox TV. He also has a website and podcast on these topics. He also speaks at the various medical conferences, and that's how we met. And his firm has authored several books, with the latest being Wealth Planning for the Modern Physician. As a matter of fact, I bought the book thinking that I could read it before our interview. It turns out it's a lawyer book, of course, so it's 316 pages. So I did not get a chance to start it or finish it. So I've invited him to Beauty in the Biz to talk about taxes. Now, taxes are not a very sexy topic until, and I have a caveat here, until you learn how much fun it is to save on taxes and keep your money. And you do it legally, of course. Now, I learned this the hard way when I was a sales rep in a Fortune 500 company a million years ago. They used to keep 50% of my commission checks on taxes, and I was shocked at that. And then when I started my own business more than 20 years ago, I learned about all sorts of new taxes that service providers, such as surgeons and consultants, were paying. That's when I read Rich Dad, Poor Dad by Robert Kiyosaki, and that just blew my mind. His whole theme is, it's all about how much you keep, not how much you make. And I thought, that's a new way to think. So in a nutshell, I love that book. I highly recommend everybody read it like 14 times. In a nutshell, he came up with these 4 cash flow quadrants, and they were based on where the money comes from. And those are E for employee, S for small business or self-employed, and that's where all of us hang around, B for big business, and I for investments. And the employees and the small business paid the heaviest taxes, where the big business and the investors paid minimal or no taxes. And boy, did I learn a lot about that. So the point is learning these creative strategies that are available to all of us, especially through David. You're going to keep a lot more of your income by protecting it from this heavy taxation. So let's hear what David has to say about preserving your income while keeping the tax man away. So David Mandell, welcome to Beauty in the Biz. It's a pleasure to have you.
Thank you, Catherine. It's a pleasure to be here. And a couple of comments before I get into 3 ideas that listeners can use to save taxes in 22. Yes, I am an attorney and still practicing, not recovering like some folks who start as a lawyer and do something else. But I do spend most of my time as a wealth manager these days. So I still have my law practice. But the reason why that's important is lawyers play a very important role in tax planning. And yet very few lawyers prepare tax returns. So I ask physicians all the time when I'm in a conference, and trying to be interactive, how many folks have somebody that prepares their taxes? And almost everybody does. There are some docs who still will do it themselves. Most have a CPA. And, right now, as we record this in February, a lot of the listeners here are working with their CPA to give them the information of what happened in 2021. And they're preparing those tax returns for a March 15th deadline or an April 5th deadline. And even if they're getting extended, they have to file something. Well, that's not really tax planning. That's tax preparation, right? That's looking backwards to say what happened last year and preparing the return. And I say, that's great. And it's important to have a good tax preparer, but there's a difference between tax planning and tax preparation. And I say, what do you think about tax attorneys? Almost none of them prepare taxes, but they're doing something. And they're billing $500, $600, $700 an hour. So it must be something that they're doing that is valuable. Now, a subset of those do controversy work, meaning representing someone when they're fighting with the IRS or the state, but a lot of them don't do that at all either. They're doing tax planning. And we built our wealth management firm around the concept of Exactly, kind of parallel to the Rich Dad Poor Dad, which is the net is what's key, right? You help these surgeons increase their gross, right? Better practice methods, better marketing methods, better ways to deal with patients so they get more referrals and more business. That's all top line, and it's crucial. What we help clients with is the bottom line. And that's what we're talking about today, which is net of tax bottom line. Maybe I'll come back and talk about protecting assets from lawsuits and other things they can do that are important. Okay. So let's focus today. You asked me, you said, hey, let's give our listeners a couple of ideas for 2022. So I'm going to talk about 3 things they can do this year to save taxes. Are you ready?
Yep.
Okay. So the first one, and I'm going to relate it because I like to listen and integrate to those quadrants you were talking about. Mm-hmm. So this first one is going to be about the small business quadrant, okay, which is taking a fresh look at your qualified retirement plan. That's tactic, or that's strategy number 1, meaning most of those listening here in their practice will have a 401k or a profit sharing plan. Maybe even they do a SEP IRA. That's not technically a qualified plan, but it sort of substitutes for one. Or maybe they even have a defined benefit plan. But what I want folks to do or listening to this is if they have an appetite for lower taxes, that's an if. Now, every surgeon will raise their hand and say, I want to save taxes. Mm-hmm. Then they should relook at their qualified plan and do a couple things there. One, look at what type of plan they have. They might do better with a different type of plan. Meaning if they have a 401k, their maximum they can put away, which is a deduction, is $20,500. A profit sharing plan is around $60,000. Mm-hmm. A defined benefit plan is around $100,000. And a particular type of defined benefit plan, and there are chapters in our book in there, and hopefully it's not too much legalese, shouldn't be really any, but so people can get through it. But a typical one type of defined benefit plan called a cash balance plan, we have clients putting away $200,000 a year into that. And that's a deduction. So that's going to write off for a lot of these, that's going to save folks $100,000 a year or in that neighborhood every year that they have the plan in place. So they want to first look at what other types of plans are out there and run numbers. The nice thing about this area is they can do with a good firm like ours or another, they can actually take the census, which means all their employees and how much they make and what their age are, and run numbers before you make a decision. Okay, there shouldn't be any risk involved. It's just about figuring out what's the right plan. Okay. Number 2 is, even if you're in a plan or a type of, is look at the formulas. Because with a 401k, with a profit sharing plan, with a defined benefit plan, they all are based on different formulas that play different roles. And people think, well, this is just how much I have to put in for my employees. And that's not necessarily so. Okay. The formulas change over time, and there's expertise, especially on the higher end plans like the cash balance and defined benefit plan. If you're working with a good actuary, they may be able to work with the numbers so that you think it was going to be too expensive, meaning you're a plastic surgeon, you have 10 employees. I can't do that plan. I'd love to put away 100, but it's going to cost me 30 for the employees. Well, maybe with the right actuary, that 30 could go down to 20 or 15. Okay. Now you're still doing something nice for your employees that you weren't doing before, but you've probably had other docs here talk about turnover and how important it is to keep good employees. Well, here's something you're doing well for the employees, but now you're also putting away an extra $50,000, $60,000 that you get to deduct, right? As the doc. So it's a win-win. Key is formulas. So plan type and then formulas. The third thing is on the piece of looking at your qualified plan is don't pay too much. And I mean, don't pay too much in fees. And I lecture on this. A lot of times people will have a bundled service with the record keeper and the third-party administrator, the person who kind of does those formulas, and the investment advisors to the plan. So a surgeon might say, you know what, this guy comes, he has all the things together and I pay one fee and it's very well coordinated. And I like that. It's bundled. That's what they call it. The problem with that is if you actually dive into it, a lot of times the fees are too high. There's actually kickbacks going back and forth between the investment advisor and the third-party administrator. So it's great for them. But if we had a plastic surgeon, specific client, I'll tell you, himself, his spouse was the key office manager, 3 employees. We looked at the plan. Okay. We said, listen, it's got two problems. One, it's too expensive. Two, it is geared for you two, but not for the rank and file. And guess what? If they get a hold of a lawyer, if you don't perform well, you have liability for that. You're a fiduciary for your employee, your rank and file. Okay. So it could be a good plan for you as an older surgeon with more risky investments and, things that you want to take advantage of, but there's not a good option for them, younger, let's say. You could have liability there. That. So we looked at that. We did our evaluation, and it turns out we said, listen, we can give you a plan that we're a co-fiduciary on, which means we're on the hook if there's ever liability. He didn't have that before. Two, it's got a better menu of options for the couple of sort of rank and file, the receptionist and all that. And then three, it's going to cost you about half in terms of the fees. So you're getting more and you're paying less. Okay. And the only reason he knew that is because he reviewed it. He had somebody outside take a look at it and have a, whatever you want to call, second opinion, workup, whatever analogy you want to call. So first idea is take a fresh look at your qualified plan. That means understand what other types of plans are there, make sure your formulas make sense, and have a review in terms of fees.
Okay. Let me just add a caveat to the profit sharing plan.
Sure.
When I'm in practices and we're looking at the benefits and the bonuses and the commissions and all of that, every single surgeon has said the staff has no idea what profit sharing is. They don't care. They just don't care. And especially with the turnover going on in today's world, just the reality is it for the rank and file or is it for the surgeon? And if there's a distinction there, what's a better plan for the surgeon who's trying to save on taxes versus using it as a benefit?
Well, they're going to try, the formula is going to be then two answers to that. One is you're going to want a formula that obviously maximizes the amount the owner can put away.
That's the bonus there. Yeah.
And if they have the cash flow to do it, they should actually look at the defined benefit plan and the cash balance plan, which I mentioned, which again, there's chapters in the book, because that, again, we have clients in the aesthetic world who are putting $100,000 away for themselves, and they're getting 95% of the benefit. So yeah, 5,000 is going to the rank and file, but they got to do something. I mean, you can't get a deduction without doing that. Otherwise you're, going to get in trouble. But if you can do something that's 95.5, then, even if it doesn't really act as a motivator for the employees, it's still a huge home run for you because now you're writing off $95,000.
Absolutely.
Got it. Okay.
All right, good one.
Okay. So number two, this is the big business one. Okay. So that quadrant, I think it was B. So the talk that I did when you and I are together, and almost every talk that I do at medical conferences, I'll ask a raise of hand. How many people have a qualified plan, 401k, profit sharing plan? And most of the docs will raise their hand. Mm-hmm. I'll say, how many people have a non-qualified plan? And most of the docs will have a blank look on their face. They'll kind of look around, and maybe one or two out of 50 or 100 in the room will raise their hand. And the concept here, and again, usually I have slides, and I do not want to get technical here. But what I'll say to the surgeons listening, you have some friends that you went to college with, that you grew up with, were really smart, but they didn't go into medicine. They went into big business, and the way they're making their wealth is in the non-qualified plan, because they could be part of Amazon. They could be part of, GE, any company you want to think of. But if it's a 401k, they have the same limitation of 20,000 as you and I have in our 401k. Mm-hmm. What they have that a lot of physicians don't have, and I'm going to say we don't have because I have it, and I've been putting a lot more money in it than my qualified plan over the last 8 years, is a non-qualified plan. Well, because it's non-qualified, you give up the deduction. So unlike what we just talked about, where you're going to reduce your taxes in 22, the non-qualified plan works like a Roth IRA, where you pay, money goes in after tax, but it grows tax-free, and if managed properly, comes out tax-free. Mm-hmm. So I would ask, the surgeons listening, if you could, because you have an income limitation, but if you don't, if you could put as much into a Roth IRA as you wanted to, how much would you put in? And that's where a non-qualified plan can come in. This is what the big businesses do. This is what they do for their executives. They're putting in hundreds of thousands, millions of dollars into their non-qualified plans for their top 50, 100, 200 executives. Because it's non-qualified, they don't have to offer it to any employees. So this is something the surgeon will do just for themselves, just for them.
So you can be in private practice and be a non-qualified plan. You can have a
yes, absolutely. And by the way, it doesn't conflict with your qualified plan. So at OJM Group, our wealth management firm, we have a 401k. And it's fine. My employees like it. I put a couple bucks in it, but I'm putting a lot more in my non-qualified plan. Now I got to pay tax when it goes in. Okay. That's the pain. But the David from retirement 10 years from now, 20 years from now, 30 years from now is so happy that I'm doing that now, because once it goes in, it's going to grow tax-free and I'm going to be able to pull it out tax-free. Okay. And so what I've found is fewer than 5%, even fewer than 2% of medical practices have that. But when I ask surgeons two things, one, how much would you put in a Roth IRA if you could? And they're always like, well, I'd put a lot more than, what I'm doing. And two, I ask, do you think tax rates are going up in the future or down in the future? And almost they always say up. I say, well, let's just think about that. If you think tax rates are going up in the future, you would really value something that locks in today's rate and you don't pay tax on it again, which is the non-qualified plan. And I'm not saying anything wrong with qualified plans, but the opposite is what we just talked about. Your 401k, you get a deduction today. There's tax-free growth, which is super valuable, but you're going to pay tax on whatever the rates are in the future, right? So what I tell people, if you're doing qualified plans, which most of the docs listening to this will be, you have to think about a non-qualified plan to hedge against that. Because for myself, right, retirement could be 10, 20, 30 years. I want to have flexibility. I want to have the power to pull something up. If taxes happen to be low, I could pull it out of my qualified plan, my 401k. If taxes are high, I pull it out of my non-qualified plan where there's no tax, right? I want to have that diversification. And most physicians don't have that. So if number one is maximize and perfect your qualified plan for deductions today, number two is look at non-qualified plans, okay, as a terrific hedge against future income tax increases, a terrific hedge against your qualified retirement plan, and a way to basically get an unlimited Roth. And finally, it's a way to do what the big boys and girls do at big business, because this is what they do.
And the non-qualified, are you saying you can pull that money out whenever you want in increments of whenever you want?
Yeah, because it's a non-qualified plan. The rules that apply to qualified plans, because you're giving up that deduction, you're also getting free of the rules of offering it to any employees. You're getting free of the 59.5 penalty before that rule, which a qualified plan like a 401k has, or minimum required distributions. Like my father's a radiologist, is forced to take minimum required distributions, pay tax on that out of his IRA that came from his, radiology practices, profit sharing plan. So all of those rules that we're accustomed to thinking about with the qualified plan don't apply, period. So that's part of the power of it, plus the tax-free growth and the tax-free access.
That's very interesting. I'll bet it's not as popular because of that sting at the beginning.
You got it. That's why most docs will come to me and say, I haven't heard of this before. Yeah. It's like, well, your CPA probably never suggested it because it's not going to help you save taxes today. Right? So what I tell clients is, listen, if you said you had 100,000 of cash flow that you don't need, right? And it's in addition to whatever savings you're doing after tax, with firms like us that manage money. But you have 100,000, you want to put into something. I'd say really look at the non-qualified plan, and then let's look at your qualified plan. Maybe you want to do 50 in the profit sharing plan and 50 in the non-qualified plan versus 100 in the defined benefit plan. Yeah, you'll get a better deduction there. But long-term, you'll be happier that you diversified. But every client's different. And that's the beauty of what we do in working with clients.
Right. Okay. That's a good one. I didn't know about that.
Yep. Okay. Number 3, and this relates to another quadrant you were talking about, which is the investment quadrant.
I like
this. So this is basically just make sure that your investments are managed in a tax savvy manner. Okay. And that's an easy sentence to say, phrase, make sure your investments are tax savvy. But there's a number of success factors in there. And one, I am going to get into the details a little bit because it's hard to conceptualize without it. But again, I want everybody to get our books for free with the code we'll talk about at the end. And there's, great examples of this. But the first one, which is an easy concept to understand, is asset location. Let's just say a surgeon has $1 million portfolio. And they're working with a firm like us. We manage $600 million. We're fiduciaries, all that. And we say, listen, your ideal portfolio is going to have, 40% US large cap. This is not what I do. This is what other experts do. And within that, and the client wants, a certain percentage of dividend paying stock. So let's just say at the end of their portfolio, there's $100,000 in sort of major stocks that pay dividends. Okay. We want to make sure that that is in their qualified plan or IRA. We want that location to be right because there's no reason for them to be paying tax on those dividends, right? They're not in retirement. They like the dividends because it's a steady rate of return, 6%, but they want to reinvest those. Okay. So there's no reason to be paying taxes on it. So, that's a simple concept. Your growth stocks you don't mind having in your name. So if you've got a couple of buckets, right? We want to think, okay, what is your portfolio? What should it look like? And then what bucket should it be in, right? To minimize the tax drag on it. That makes sense, right? Mm-hmm. Okay. So another concept that's key to tax planning is what's called gain and loss harvesting. Okay. And what this basically means is have your eye on your portfolio and its elements at all times, and be very proactive to think about in the same asset class, what other funds or ETFs or other investments you could use as a backup. So you might be in fund A, but and your firm is doing the research that if we need it, we could go to fund B, which we have a lot of confidence in. And the reason you want to do that at all times, people think gain and loss harvesting is always in the fourth quarter. You take a look at, hey, how much did I pay in tax this year? What assets do I have that maybe I could sell for a loss because I had a windfall? Maybe I sold a building or I had a really good year at the practice. And that's part of it. But I want to give you a real example why it shouldn't wait to the fourth quarter. Okay. Mm-hmm. So I want people to listen to this. Let's go back to March 2020 when the market was tanking, right? When the COVID was coming on the scene. Well, we had a particular client who, we had done this research in advance of COVID even showing up. We said, we always have an idea, okay, in particular parts of a client's portfolio, what would we go into if we wanted to exit out of this asset? So in a part of his portfolio in the international, they had a fund, it was Lazard, the strategic fund, which was valued at about $540,000. Now, it had underperformed. Portfolio had been doing well, but this was one piece of the portfolio that really underperformed. There was a loss there. Now we thought it would come back, so we hadn't done anything. It was unrealized, but we saw the market tanking. And we said, this might be the time to just sort of bite the bullet, sell that, and go into the other fund that we were looking at and harvest that loss. So that's what we did. Okay. This was March 18th, 2020. We sold that and realized a loss of $109,000 for the client. Okay. But the next trading day, we invested that in another fund. It was a Fidelity overseas fund that we'd done the research on, right? So same part of the mix. If we said, okay, we want 5% in this particular part of your portfolio and this kind of, international exposure, we just traded one for the other. Harvest the loss, put in the other one. Well, obviously from March on up, the rest of that year was kind of a straight line up. So at the end of that year, that fund was up 63% from that low in 20 up to 800,000. Now the previous fund would have done well too, but the difference is because we shifted at that time, that in addition to this huge, increase up to 800 something thousand from 540, they had on their tax return a loss of $109,000. So they were in the ideal position, right? They had growth on their position, their portfolio. They were wealthier, but from a tax point of view, they had a $110,000 loss. If we had never done that, we just left it in the fund and just say, let's just wait it out, they still would have come up. I don't have the numbers in front of me, but I think they probably would have performed not that dissimilarly to the Fidelity fund. Maybe a little less, maybe a little more, but in that ballpark, it's the same, but they wouldn't have had that loss, right? Now they have that $109,000 loss that they can apply to other gains that year or carry it forward. So that's the kind of opportunity that your investment advisor, if you're doing it yourself, that you need to be doing. And this is one of the things that it's very hard for a surgeon if they're doing it themselves. They may be able to pick assets, but to be able to be on top of them, do the research and have the confidence to execute a trade. And I saw your face when I said, oh, they lost 109,000. It was not a good face you gave. So we had to, as an investment manager, say, you know what? We're going to do it, even though we're losing 109,000 on this trade over whatever it was, 5-6 years, because we believe in what's going to in our strategy, and it worked. Right, the client had the upside; they gained in that part of their portfolio, but they also had a loss. And I could give a bunch of other examples, but I don't want to get into the details. The point of it, the lesson is that gain and loss harvesting, there's a year-round thing. It takes research. And it takes the confidence to be able to make those moves when you think that you'll benefit from it.
That feels tricky to me because it's not day trading, but it's definitely a part-time job, like watching all that. I was always taught just buy good stock and leave it alone. And I'll drive myself nuts if I watch that. So I don't. I'm not big on the stock market. I just have just little things that I like, and I look at them periodically. And otherwise, I'll never sleep.
Yeah. Well, I'm very much like you. I mean, I'm a founder of a wealth management firm, OJM Group. I'm the M. So I founded this firm 14 years ago, after practicing law for about 12 years. But I don't really check my balances that often. I have the portfolio managers. I'll do the quarterly call and, I have some ideas and this and that, but I'm not someone who checks it every day. Unlike my brother, who's a cardiologist who does check things quite often. So it really has nothing to do with what your chosen field is. So you're going to have surgeons who do that and are very active, and surgeons who are more passive, and you'll just say, listen, I want to find a good firm, trust them, buy into their business model, their fiduciaries, et cetera. And that's what we do. We help clients in that way.
I know so many surgeons, because I've asked them, like, where do you put your money? Like, where are you investing? And 9 out of 10 times they say stocks. And I don't think they're doing this harvesting though, or maybe they are doing this harvesting, or that just seems like, questionable to me. I personally really like real estate. I like it a lot. I like real estate and investing in cash flowing properties, so I like syndications and I love the depreciation on that. The appreciation, the depreciation, that I'm much more comfortable with. The stocks, not as much so. But what do you suggest that these doctors do when they're investing? And I assume you have a different answer for somebody who's just started out versus 15 years in versus ready to exit.
Sure. So, well, listen, I mean, we have 1,500 physicians we've worked with over the years. So we have docs who are really into real estate, who are kind of, it becomes their hobby or sort of second business. I mean, as you know, real estate takes research. You have to know what you're getting into. As a lawyer, the few clients I've had, physicians who filed for bankruptcy over the years, it's all been with real estate. It's been them buying, like right now, when things are just exploding, signing a lot of personal guarantees. And then the market turns and, they have a $5 million property and a $4 million note, and the property is now worth $2.5 million. And the bank's not walking away from their $4 million note with their surgeon. So
why in the world did they put their name on that?
Well, a lot of times they have to get the good loan. So the point of all of that is that, my advice to a client would be figure out if you're going to try to do this yourself and you really have the acumen and the discipline and the time. Okay. Those are 3 different things: acumen, discipline, and time. Because if you don't have all 3 of those, you'd be much better to outsource it to a professional. Right. And I do that myself to my firm. It happens to be my firm, but I don't really have an interest in it, whether I was a corporate lawyer or entertainment lawyer, like I was in the beginning of my career, or a wealth manager. I want someone else watching it and doing it all day. It doesn't mean that a firm like ours or others don't have real estate as part of it. There's private REITs, there's public REITs, there's private debt, there's syndications, which all basically describe all of those things. But there's alternatives, et cetera. So it doesn't just mean stocks, right? There's lots of different kinds of assets, from private equity to hedge funds and all that kind of stuff that make up a portfolio. But I think the key question is, are you going to do it yourself? Or are you going to try to find an advisor that you trust to help you with that? And then we could do a whole nother podcast on how do you find an advisor you trust? What are the questions to ask? And I'm happy to come back and talk about that.
Right? Because that's a big deal. Like, I mean, we all know the strategy, but it's how do you execute this strategy and who do you execute it with? Those are the $1 million questions that get us tripped up.
Happy to come back on another time and talk about that. But hopefully today, at least the people have gotten some good ideas on taxes. Again, just to summarize, qualified retirement plan, that's your business. That's your business quadrant. Okay. You can have significant deductions there. You can have a good percentage and maybe a lot higher than you think of the deductions versus the employees, but don't get caught in paying too high fees or having the plan have liability potential in there. 2 non-qualified plans. You seem to really like that idea. That's the big business idea that I've been doing myself, putting a lot more in than my qualified plan. Yes, the pain is no deduction up front, but there's a lot of joy in the future for you if you do it. And then 3, investments, make sure they're managed in a tax savvy manner. And that may mean use of a professional for some part of your portfolio, because as you said, it's kind of hard to do it yourself.
Yeah, this is really good information. I learned a lot on this one. I like that. Number 2.
I'm glad you did.
Yeah. So where can they learn more about you and your strategies?
Sure. So a couple things. We've got a lot of free content. Okay. So ojmgroup.com, our website, is a good place to see our bios, et cetera, learn all about us. ojmbookstore.com. Okay. ojmbookstore.com. If you go there, you'll see our books. And we've got 3, we've written 15 over the years. We've got 3 that are out there now. One's a CME piece. So if you need CME, get that, risk management for the practicing physician. Doesn't talk about anything we discussed today. Our flagship book is Wealth Planning for the Modern Physician. Okay. That was the one you mentioned in the bio. That's got sections on taxes, on asset protection, on investing, et cetera. So that's a good overview. Great material there. It's got sections on like defined benefit plan, things I talked about today. And then the other book, Wealth Management Made Simple, that is really all about investing. So it gets into the questions you should ask and business models that are out there in the financial space. What does it mean to be a financial advisor? It means nothing. If I know what a board certified plastic surgeon is, I know what it means. I know what they have to do that. I know what a dermatologist has to train to do that. I don't know what a financial advisor means, and that's on purpose. So we kind of peel back the curtain to say, these are the different business models there, right? We talk about tax savvy investing. So those are the 2 books. And normally you'll see all the pricing on that. But as a listener to the podcast, write this down. And I know it'll be in the show notes, et cetera, but Beauty 22, like the year. If you put that code in at checkout, you will get the books for free, whether it's a hard copy, if you're old school, Kindle, iPad, PDF, whatever works best for you. So OJM Bookstore, Beauty 22.
That is fantastic. Thank you so much, David. I really appreciate your time. This was really insightful, and I hope my audience appreciated that. Please check out his website. I think he's got some really good stuff. And I love that it's for physicians. He understands. And apparently you came from a big family of physicians. What now?
I'm the black sheep. I'm the only one. Science was not my thing. So yeah.
Somebody had to be the lawyer. So I guess
that's right. That's right.
All right. Thank you so much. Everybody, if you appreciated this, please give me a review over at Beauty and the Biz at iTunes. I would certainly appreciate that. And then if you've got any questions for me or for David, you can certainly leave them at my website at catherinemaley.com. I'd appreciate you sharing this out to your staff, with your colleagues. And then if you want to catch me on Instagram, you can always DM me at Catherine Maley MBA. Thanks so much, and we'll talk again soon.